All right, stop scrolling for a second because something big just snapped back into motion. Silver crashed to about $71 last week, margin calls everywhere, forced selling, panic, and now, just days later, it's trading around 90 in Western markets. That's a 25% rebound in a blink. And here's the part people are missing. Shanghai spot is sitting near $104 right now. That's a $14 to $15 premium, roughly 16%, screaming physical demand. Both futures volume and the Asia-West spread just confirmed this shift, and if you stick with me, I'm going to show you why this setup could matter by Friday, not months from now. If you're watching this and you've been following metals, you're ahead of the news cycle. Your job is to understand what's actually happening before everyone else figures it out. Before I explain what caused this snapback, let me teach you something most people never really learn about metals markets. Price isn't just a number. It's a negotiation between paper leverage and physical reality, and understanding that distinction is everything. Most of the time, futures dominate because leverage is cheap and liquidity is deep. You can control 100 ounces of silver with a fraction of the cash you'd need to actually buy those ounces. So naturally, that's where the action concentrates. That's where traders make fast moves. But here's what happens when that system gets stressed. When leverage gets flushed out, when margin requirements spike and weak hands are forced to sell, the paper side collapses faster than the physical side ever could. Think of it like a crowded theater where everyone rushes for the exit at once, then realizes half the audience actually wanted to stay. The panic creates a void. Once that panic clears, there aren't enough sellers left. That's when price doesn't walk, it jumps. And if you learn to recognize that moment, you can spot it again and again across different markets, different cycles, different assets. So what does that tell us? It tells us that violent moves down often create the conditions for violent moves up. Not always, but when you see mechanical liquidation, not fundamental deterioration, you're watching a reset, not an ending. The key is distinguishing between those two things. Fundamental selling happens when the story breaks. Mechanical selling happens when the structure breaks. One creates new lows that hold. The other creates false lows that don't. And we're going to come back to that idea throughout this entire breakdown because it's the foundation of everything I'm showing you today. Now, if this is making sense, drop a comment below and let me know what markets you're watching right now. I read every single one, and it helps me understand what you want to see next. All right, let's keep building. Here's the mental model I want you to carry forward. When you look at any commodity, you're really looking at two markets operating at the same time. There's the paper market, where contracts change hands, where speculation happens, where leverage amplifies every move. And there's the physical market, where actual metal moves from vaults to refineries to manufacturers to investors. Most days, these two markets trade in sync. Futures lead, physical follows, spreads stay tight, everyone's happy. But when stress hits, they decouple. And that decoupling is your signal. It's telling you something's broken in the chain. Either leverage is too high, or physical demand is too strong, or both. And when both happen at once, that's when you get the kind of setup we're seeing right now. Now here's what's actually happening in sequence, step by step, cause and effect. Last week, CME margin hikes forced liquidation across silver futures. They raised the amount of cash you need to hold a position. That doesn't sound like much, but when you're leveraged 10 to 1 or 20 to 1, a margin hike is a demand for immediate cash. And if you don't have it, you sell. You don't choose to sell because you think silver's going down. You sell because you have to. That's mechanical selling, not bearish conviction. So funds that were long silver, funds that might still believe in the trade, they had to dump contracts into the market. Price collapsed. And as it collapsed, it triggered more margin calls on other positions, creating this cascading liquidation event. $71. That's where it bottomed. That's where the forced selling finally exhausted itself. But here's the critical part. While Western futures were imploding, shorts got emboldened. They saw momentum breaking. They saw long liquidation. They saw blood in the water. So they leaned in. They added short positions, thinking the move lower had legs, thinking this was the start of a bigger breakdown. And I get it. When you see a waterfall decline like that, it feels like gravity's taken over. But what they missed, what a lot of people missed, is that physical buyers, especially in Asia, never left. Shanghai kept paying up, holding prices above $100 even as Western screens flashed red. Even as futures collapsed, the physical bid stayed firm. That premium didn't compress, it expanded. And that's your tell, that's the market whispering that this isn't a fundamental breakdown, this is a structural dislocation. So what happened next? When forced selling finally ran out of fuel, when there were no more leveraged longs left to liquidate, buyers stepped back in aggressively. Futures turned higher. Volume expanded. And suddenly those shorts who'd gotten aggressive at $71 realized they were leaning the wrong way. They were short into a market that had already flushed all its weak hands. They were short into a market where physical demand was still rock solid. And now they're starting to feel pressure. That's the snapback. That's the 25% move in a matter of days. But here's the part that should make you pay attention because this is where it gets interesting. Rising futures prices plus a persistent Shanghai premium don't just coexist, they reinforce each other. Let me explain how. When futures tick higher, arbitrage opportunities tighten. If you can buy silver in New York at 90 and sell it in Shanghai at 104, you're making $14 per ounce minus shipping and insurance. That's a huge spread. So arbitrageurs start buying Western futures and shipping metal east. That buying pressure lifts Western prices. It pulls them toward physical reality. Meanwhile, Shanghai refuses to break. It acts like a magnet. It sets a floor under the entire structure. And as long as that premium persists, as long as physical buyers keep paying up, Western futures can't drift too far below without creating free money for anyone willing to move metal. Now let me show you what very few people are talking about. When leverage is flushed and price starts rising again, there's no overhead supply from weak hands. Think about what just happened. Everyone who was going to sell because they had to, they already sold. They're out. They're gone. So as price climbs back, there's just open air above. There's no resistance. There's no wave of profit taking from people who bought lower, because those people got shaken out at 71. What you're left with is a market that's incredibly clean from a positioning standpoint. And that's how squeezes form after crashes, not before them. Before a crash, everyone's long and leveraged and vulnerable. After a crash, everyone who was vulnerable is already gone. The only people left are the ones with conviction and the ones who are now trapped short. And if you're trapped short in a rising market with strong physical demand, you've got a problem. This is the exact same playbook we saw in 2011 and again in March of 2020. Let me walk you through both because the pattern is almost identical. In 2011, silver had been rallying hard. It peaked around $49 in April. Then margin hikes came. Sound familiar? CME raised margins multiple times in a matter of weeks. Leveraged longs got crushed. Price collapsed to around $26 by late September. That's a 47% drawdown. Sentiment flipped bearish right at the lows. Everyone thought the silver run was over. But what happened next? Selling pressure simply stopped. There was nobody left to sell. And when that happens, when the last seller sells, price doesn't crawl back, it launches. Silver rebounded to nearly $35 within weeks, not a slow grind. A multi-week surge that shocked everyone who thought the damage was done. Same pattern we're seeing today. Forced liquidation. Bearish sentiment at the lows, then a snapback that's faster and stronger than anyone expected. March of 2020 is even more instructive because the setup was nearly identical to what we're seeing now. Silver crashed from $18 to $11 in a matter of days as COVID panic hit markets. Margin calls everywhere. Funds liquidating everything. It looked like the world was ending. But you know what didn't break? Physical demand. Dealers were sold out. Premiums on physical silver exploded to $5, $6, $7 over spot. The paper market was saying $11. The physical market was saying $18. That's a massive disconnect. And what happened when the panic subsided? Silver didn't just recover, it overshot. Within months, it was back above 18. Within a year, it hit 28. The rebound wasn't proportional, it was explosive. And the key insight is this. Crashes caused by mechanical stress tend to reset markets, not end them. They flush out the weak hands. They clean up positioning. They create the conditions for the next move higher. And every time this pattern appears, the bounce is faster than people expect, because positioning is so clean and because physical demand never actually disappeared. Now here's the larger story, the thing you need to zoom out and see. Metals markets operate on a cycle of leverage expansion and leverage contraction. During expansion, futures lead. Prices rise on speculation and paper demand. Leverage builds. Positioning gets crowded. Then something breaks. Margin hikes. Macro shock. Geopolitical event. Doesn't matter what. Leverage contracts violently. Prices crash. Everyone panics. But if the underlying physical demand is still there, if the fundamental story hasn't changed, that contraction creates a spring. It loads the market with potential energy, and when that energy releases, you get moves that dwarf the initial decline. We saw it in 2011, we saw it in 2020, we're watching it unfold again right now. Now, before we go further, let me be skeptical for a moment, because I want you to hear independent thinking, not just hype. Could this fail? Absolutely. Shanghai premiums can compress if physical demand softens or if supply increases. Maybe Chinese buyers step back. Maybe Western mints ramp up production and close the gap. Futures can stall if macro conditions deteriorate. A sudden shock to risk assets broadly, maybe a banking crisis, maybe a geopolitical escalation that could hit everything, including silver. And yes, manipulation narratives always surface around metals. People talk about bullion banks suppressing prices, about concentrated short positions, about regulatory capture. Could that be happening? Maybe. I'm not here to tell you it's not possible. But here's the thing. It doesn't actually matter whether those narratives are true or false. Arguing about motives doesn't help you trade structure. You can spend hours debating whether JP Morgan or HSBC or whoever is manipulating silver, and at the end of that debate, you still don't know what to do tomorrow morning. The mechanics are what matter. Focus on what you can control. Focus on what you can actually see. Price, volume, spreads. If those start breaking down, the thesis weakens. If 90 fails as support, if Shanghai premiums compress to single digits, if futures volume dries up, that's your signal. Until then, the market is telling a story whether we like it or not. And my job isn't to tell you what to believe about why it's happening. My job is to show you what is happening and give you the tools to interpret it yourself. There are probably 3 types of people watching this right now, and I want to speak to each of you directly. Maybe you're the one who got shaken out during the crash. You were holding silver, maybe physical, maybe futures, maybe miners. You watched it drop from 90 to 71 and you couldn't take it anymore. You sold, and now you're watching it bounce back to 90 and you're feeling sick. You're wondering if you already missed the move. You're thinking about jumping back in. Let me say this clearly. Missing the bottom is normal. It happens to everyone. The people who claim they bought the exact low are either lying or lucky. What matters is what you do next. Chasing blindly isn't the answer. Revenge trading. Trying to make back what you lost by jumping in without confirmation. That's how you lose twice. You want confirmation, not emotion. You want to see 90 hold. You want to see 95 break. You want to see volume support the move. Give yourself permission to miss the first 20% if it means you catch the next 50 with confidence. There's no shame in waiting for structure. Or maybe you're already long and you're feeling that mix of relief and disbelief. You held through the drop. You didn't sell at 71, and now you're up, but you don't know what to do. You're scared it's going to reverse. You're tempted to take profits. For you, discipline matters more than excitement. This is where most people blow it. They survive the crash, they're sitting on gains, and then they either hold too long and give it all back, or they sell too early and miss the real move. Know your levels. What's your stop if this breaks down? What's your target if it breaks out? Protect gains, but don't strangle the trade. If you're holding physical, you've got time. If you're holding futures or options, you've got risk. Manage it accordingly. Don't let relief turn into complacency. And maybe you're the skeptic who thinks this is just another head fake. You've seen silver rally before. You've seen it fail before. You're not buying the hype. That's fair. Skepticism is healthy. Your edge is patience. You don't need to be early. You can wait for the market to prove itself. Watch 90 hold. Watch 95 break. Watch the Shanghai premium persist. If all 3 happen, the thesis strengthens. If any of them fail, you saved yourself from a bad trade. There's no prize for being first. There's only profit for being right. So use that skepticism. Let the market come to you. No matter which camp you're in, the principle is the same. Respond to structure, not emotion. The market doesn't care what you paid. It doesn't care how you feel. It only cares about supply and demand, about positioning, about the balance between paper leverage and physical reality. Your emotions are valid, but they're not a trading strategy. Build a framework, use levels, watch for confirmation, and make decisions based on what the market is showing you, not what you wish it would show you. So here's what I want you to answer in the comments. Which category are you in? Are you sitting on the sidelines wishing you'd held? Are you long and trying to figure out your next move? Or are you skeptical and waiting for more proof? I'm genuinely curious, and I think sharing where you're at helps everyone see they're not alone in this. All right, here's where I stand. I'm not predicting a number for clicks. I'm not telling you silver's going to 150 by next month. I'm tracking signals. I'm watching how the market is behaving and interpreting what that behavior means. And right now the signals are telling me this move was mechanical, not emotional. Let me tell you what I'm personally watching. First, I'm watching 90 as support. If that level holds, if we get a pullback and it bounces off 90, that confirms the crash was a reset, not the start of a bigger decline. It tells me buyers are real. It tells me demand is absorbing supply. If 90 breaks, everything changes. Then we're looking at a failed bounce, and I'd expect a retest of the lows. But if it holds, that's your foundation. Second, I'm watching a momentum trigger through 95. Why 95? Because that's where shorts start feeling real pressure. Remember, a lot of shorts leaned in around 75 to 80 thinking this was a breakdown. If price pushes through 95, they're underwater. And when shorts get underwater in a thinly traded market, they cover. That covering adds buying pressure. That buying pressure pushes price higher. That creates more covering. It's a feedback loop. So 95 isn't just a number. It's a psychological and structural level. If we break through with volume, Watch how fast the move accelerates. Third, I'm monitoring that Shanghai price above 100. If it stays there, if physical demand in Asia remains strong, if that premium doesn't compress, then 100 becomes a magnet, not a fantasy. It becomes the level Western futures are gravitating toward. And when you've got futures at 90 and physical at 104, that's a gap that wants to close. Either Shanghai drops or New York rises. Based on what we're seeing in volume and positioning, I think it's more likely that New York rises. Based on my analysis, this event last week was structural and technical, not fundamental. The underlying story hasn't deteriorated. We're not seeing mine supply surge. We're not seeing industrial demand collapse. We're not seeing a shift in monetary policy that kills the inflation trade. What we saw was a leverage flush, a mechanical event. And those events, as brutal as they are in the moment, tend to create opportunity, not destroy it. The fundamental picture for silver, the industrial demand from solar, from EVs, from grid infrastructure, the investment demand from inflation concerns, from dollar weakness, from geopolitical instability, none of that changed. The only thing that changed was who's holding the contracts. And now, after the flush, the people holding are stronger hands. That's a better setup, not a worse one. If history rhymes, and if silver can hold above 90 and push through 95 with expanding volume, the move that follows could surprise people who think the story already ended. I'm not saying it's guaranteed. I'm saying the setup is there. The pattern is recognizable, and the risk-reward, if you're managing it properly, favors the upside more than the downside right now. But you need to watch those levels. You need confirmation. You need to see the market validate the thesis, not just hope it does. Now let me be crystal clear. I'm not a financial advisor. This is not financial advice. I'm showing you how I'm interpreting the data. I'm teaching you the patterns I'm seeing. But you need to do your own research. You need to verify everything I'm saying. You need to make your own decisions based on your own risk tolerance, your own time horizon, your own financial situation. Don't take my word for anything. Go look at the charts. Go check the Shanghai premium yourself. Go read the CME margin requirements. Go study the 2011 and 2020 examples and see if the pattern holds up. That's how you build conviction. That's how you develop the skill to recognize these setups on your own next time. Because there will be a next time. This pattern repeats. Leverage builds, leverage flushes, markets reset, opportunities appear. If you learn to see it once, you can see it again. If you made it this far, you're part of a small group of people who actually care about understanding how markets work, not just chasing tips and hot takes. That mentality will serve you well. It'll protect you from getting caught in euphoria at the top and panic at the bottom. It'll help you see structure when everyone else is seeing chaos. So keep that curiosity, keep questioning, keep learning. And if you found value in this breakdown, do me a favor. Share it with someone who's trying to figure out what's happening in metals right now. Hit the subscribe button if you haven't already, because I'm going to keep tracking this setup as it develops, and I want you to see how it plays out in real time. There's a lot more to unpack here, and we're just getting started. Stay sharp out there. Think critically, verify the data, and make your own decisions. I'll see you in the next one.